Hey guys, in today's video I'm going to cover the audit assertions. Xin chào các bạn, ngày nay anh sẽ giải thích mấy kiểu kiểm toán. Hola amigos, hoy explicaré las formaciones de auditoría. I'll share my strategy on how I've memorized them. I use a mnemonic, which is like a catchy phrase, and I applied it visually to a character named Saitama from a series called One Punch Man. You can apply the strategy to any character or subject, but this is how I remembered it, and it has stuck with me until now. Let's get started. There are 5 audit assertions for income statement accounts, aka class of transactions. They are occurrence, completeness, classification, accuracy, and cutoff. I use the phrase, it occurs with complete class and accurate cut to remember these 5 assertions. So occurrence, this addresses the risk of has the transaction actually occurred. So for example, on the books, the company may record $1,000 in sales, but is it real? Was there an actual sale of $1,000? The assertion is primarily used for revenue, where the incentive is to overstate revenue, to make a company look like it's doing better than it actually is. Second is completeness. This addresses the risk, has all the information been recorded, or am I missing some information or missing a transaction from this population? So for example, the population for expenses may show $2,000, but should the total actually be $2,200? Is there a transaction of $200 missing or being omitted? The assertion is primarily used for expenses where the incentive is to understate expenses to make a company look like it's doing better than it actually is. So third, classification. This addresses the risk if the transaction has been recorded to the correct GL account. The classification assertion only applies to income statement accounts such as revenues and expenses. So for example, a transaction of $20, has this been correctly recorded to operating expenses, or should it belong in the G&A expense? I remember complete class as it relates to Saitama because what other character can be more classy than this guy? Fourth is accuracy. This addresses the risk, has this transaction or all transactions been recorded for the correct amount? So for example, a transaction of $99 should be recorded for $99 and not $98 or $9.90. It's been recorded without error. And then fifth is cutoff. This addresses the risk, has the revenues or expenses been recorded in the correct reporting period? So for example, if an expense occurred in 2020, it should be financially reported in 2020 and not in 2021. I remember accurate cut as it relates to Saitama because I think of how shredded and cut he is. His abs are accurately symmetrical. Okay, moving on to balance sheet assertions. There are 4 audit assertions for our balance sheet accounts, aka account balances. They are existence, completeness, rights and obligations, valuation and allocation. I use the phrase, it exists completely with rights and value to remember these 4 assertions. So first, existence. This addresses the risk, does the account balance actually exist? So for example, a company may report $1 million of assets, or in reality, do they only have $900K worth of assets? The assertion is primarily used for assets on the balance sheet, where the incentive is to overstate assets, to make a company look like it's in a stronger position than it actually is. The testing direction would be from management records to third party. Second is completeness. This addresses the risk, has all the account balances been fully recorded? So for example, a company may report $500K in loans of liability, but in reality, is the total amount owed actually higher at, let's say, $700K? So the assertion is primarily used for liabilities on the balance sheet, where the incentive is to understate liabilities, to make a company look like it's in a better position than it actually is. The testing direction would be from third party to management records. So third is rights and obligations. This addresses the risk of, are these account balances under the ownership of the company reporting it? So for example, if a company reports a truck as an asset for $50K, that company should have the rights and ownership of that truck. It shouldn't belong to another party. Fourth is valuation and allocation. This addresses the risk of, have the account balances been valued and report it at the appropriate amounts. So for example, to test the impairment of an asset, you can obtain a valuation report from an independent qualified appraisal firm and see if the company has reported an amount that reasonably aligns with the third-party report. So this brings me to the end of the video. I hope you guys found this video helpful. If you guys want to tune in for future videos, subscribe and hit the notification bell so that if I do create a video that you might find useful, you won't miss it. Thanks again for watching, and I will catch you guys in the next video.